what is a yield fund? So today we're going to be talking about the Grimes County asset and really a unique investment vehicle that EnergyFunders is excited to showcase. And we're actually doing this webinar right after the Fed has spoken, and they'll be holding interest rates at 0. So what we hope to bring to the platform and to investors are assets and projects that do not carry the significant risk level that wildcatting does, but also allow the investor to get paid back first, reach a certain rate of return, which we do believe could beat the market, and at the same time, give them some opportunity as oil prices recover. And those are some of the critical things that we're looking for when we produce a project on the yield fund. So just real quick, a yield fund, it's different than owning working interest outright. So you as the investor, you're more of a financial backer. And in exchange, you get an undivided portion of the asset or the working interest owned by the E&P company until a predetermined hurdle rate is achieved. And then once that hurdle rate is achieved, then you get what I call it's all the profit. So as the well continues to produce and it succeeds for years to come, all of that revenue gets paid to you on a quarterly basis. So it's a really nice project in the sense that you have no startup cost. So a nice thing about these type assets is that the startup cost, seismic, the land, the participation fee, the operator's fees, anything that's typically charged on the front end of a traditional asset, the investor's not paying for. And the investor's dollars are going directly into the drilling and the completion cost of the well. And because of the timing of this well and the length of payback, which is roughly, we're estimating about a year, the intangible and drilling cost and tangible drilling cost, including any bonus depreciation, does pass on to the investor. So there will be a K1 into the year. And then depending on how you elect as a general partner or a limited partner, you can take those deductions. So that does play a role in the yield fund, which can obviously increase that overall internal rate of return. Now, in our projects, the IRR rate is 15%. And so the way this equates is 1.25% per month that's being calculated, paid out by the production of the wells, and it's calculated on the outstanding balance that's owed until that hurdle rate is achieved. So it's a pretty nice, phenomenal process, and we will be doing another video that's going to go through how that all pays out. But let me give you kind of a visual. Over here on the left-hand side, you'll see that the E&P company conveys working interest to the investor in exchange for carry and reversionary interest rights. The investor, which would be you or EFEC 37, retains the working interest until that IRR or ROI hurdle is reached. Then it reverts to a lower percentage of the working interest, and it stays until the life of the well. So the advantage is the investor receives 100% of their investment capital back monthly, plus that really accruing 1.25% on any outstanding balance. No, this is not a loan, but it is calculated that way to be able to get that investor their return profile on the well. Now, the smaller interest in the project for the life of the asset really is all profit. And one of the things that we like about it, and I'm about to turn this over to Navit so he can go through and show you guys the project and why we're really excited about the combination of, but this aligns the E&P company, which in this case would be Paleo Oil Company, with the investor. And they're aligned incentives because the operator, Paleo, wants to pay you back faster, obviously, because the interest is accruing over time. And vice versa, you as an investor want to receive your money back first with your rate of return, and then hopefully have that successful well where there's a tail. Now, one other little comparison before I kick it over to Nav is, if you looked at a real estate investment, some of the real estate platforms that we've seen out there, you put your money in, that money then earns interest. And then once there's an exit, either the sale of the asset, a liquidation period, you recoup 100% of your money that you put in, and then you had your interest. What's different in the yield fund is that you're receiving your principal, your investment back as quickly as possible during based on the waterfall and how the cash flows go, plus that interest that's being accrued. So in that time period of payback, you're receiving your money, then you can go back once you have that money and you can reinvest again into another yield fund, or you can, the time value of money, right? You've got that opportunity now that the money's back, your principal. but you're going to be earning that interest for the tail of the whale. And so some of these can pay out for, 8, 10 years. So it's really important to see kind of the inverse relationship between more of a real estate fund and what we're offering here with our yield fund.